So again, type curves, very important, but they're also the most manipulated disclosure. And we'll talk about three key patterns to watch based on sort of my experience of having followed this for 15 years. So the first game that I'll talk about is what I'll call cherry-picked type curves. Now, the issue is kind of more broad than just cherry picking wells, but we'll kind of talk through it. So type curves, a type curve basically implies a representative well. So on average, when a company drills a well, what should you expect, right? As an investor, and in practice, management actually gets to choose which wells go into the average. There's no real kind of regulation around this. So what you'll often find is that companies will essentially filter down to the core acreage, right? The best acreage that it has, the most recent vintage, right? Where, all the learnings have already been incorporated and all the previous kind of failures or suboptimal wells are kind of excluded. They'll include the longest laterals, right? And they'll show you kind of a non-lateral adjusted type curve, and wells without mechanical issues. They'll tell you that it's not fair to look at those because there are issues. But I would argue, you're going to, unless you can guarantee that you're never going to drill have another issue with a well, I think you need to include some of these kind of suboptimal wells, because otherwise there's a bit of survivorship bias. So each of these filters in isolation can be justified, right? The issue is when you stack all of these kind of filters together, what you end up with is essentially a holy grail type curve that represents the best wells that the company has ever drilled, presented as representative of the entire inventory. And that's just simply not true.